Well, we're rolling into what could be a very lively July. Certainly the NASDAQ seems to like July. But in terms of event risk, we're looking ahead at US earnings. We've got FOMC, ECB meeting, a whole raft of central bankers, as well as in Australia here, the Q2 CPI numbers, which could have a big ramifications for whether the RBA look to hike rates in that August meeting. Now, we're also looking very politically minded nearer term. We've got the French elections, which are unfolding before our very eyes at the moment. We've got a UK election, and the bond market is really clearly speaking out about what Donald Trump brings to the table longer term as well. Now, in terms of markets, we are looking very much at the tech trade at the moment. That continues to fire up and outperform. We're looking at crude, which is finding good upside bias at the moment, and the yen, which continues to find few friends in this market. This is the trade-off. Well, bonjour, my name's Chris Weston, Head of Research here at Pepperstone, and we're joined in 2 seconds by Blake Morrow from Forex Analytics, and we're going to be discussing all the factors that we're seeing in these financial markets, looking at some of the charts and setups front of mind, and some of the trades that we like at the moment. Mr. Blake Morrow, my good political expert, would you come back into the programme, sir? How are you dissecting these cross currents that we're seeing? Is it too hard basket? Don't worry, just follow price action.
Je ne parle pas français. Did I say that right? No.
Mate, just get on ChatGPT. It works it out for you, mate.
There we go. It's what a heck of a weekend, and a heck of a gap move in the euro and the fixed income markets. It's been a crazy start to the week, and I have a feeling, Chris, it's going to get even crazier as the week goes on. You got traders here in the U.S. that are starting to leave their desks, and liquidity is going to get really poor, and there's still a lot to come this week.
Well, I didn't get an invite to the Morrow family 4th of July cook-up. I'm sure you're going to be doing something fantastic. Big old feast going on your neck of the woods, Blake?
I'll be in Southern California enjoying some beach time, so yes.
Oh, sounds absolutely ideal. Anyway, let's talk about the markets. Let's check the market pulse. Right, I want to start with politics. We've got the French election. As I speak at the moment, we've got a good understanding about the way that votes have gone. The way that this works now is going to get very political, very sort of tactical. There's been over 300 constituencies, which has seen over 3 candidates going through, in some cases 4. The left bloc have said that they'll pull any candidates out who have been polling third so that the centrists can get more of a say, and then try and tie up what we were seeing from the far right RN party. But the way that the market's looking at this at the moment, there's probably 2 outcomes. One is that we get an RN majority under Le Pen, which markets may struggle with a little bit, but it's not a terrible scenario. And then obviously the other one is that a hung parliament comes through. That seems to be the 2 factors that the market's running with. We'd look at that. Obviously then you've got the bond market seems to be speaking out right now, Blake, about the prospects for Donald Trump and deficit spending, and some of the measures being inflationary, and that's really quite a powerful message that I'm seeing. And then you've got the UK elections, which is very idiosyncratic, and probably not too much of a trade there. Yeah, which ones are really sort of consuming you at the moment there?
Well, obviously, since last time we talked was on the eve of the debate, and as I said, it would be embarrassing, and it sure was. So that the political landscape here in the U.S. is going to be continuously evolving for the next couple of weeks. So just stay really close to your computer, and especially if you hear Biden dropping out or something like that. Now, the flip side to that is you look at the European political situation, and I guess I'm thinking, is an RN majority? They'd have to. Well, Macron would have to put in a prime minister, right? Which would be
Jordan Bardella.
I think it's cohabilitation. Is that what they call it?
That's I forget that's exactly right. Yeah.
Okay, so that isn't a worry for you, and do you think it's a worry for the markets as we head into round 2 this weekend?
I don't think so, and I think it would be what I think and what the markets think. Obviously, could be 2 different things. What's important is what the market thinks. Now, look, first of all, you know, like they have campaigned on fiscal spending and support, but they've also told us that they're not going to be reckless, and that's the ultimate issue with France is that people are concerned that their finances are in a very poor trajectory at the moment. They've just been placed on excessive deficit monitor by the European Union, the European Commission, and their fiscal position's only getting worse. So you get a party like the RN Party coming out and spending recklessly, which is unfunded. Then you've got a bond market situation. So it's fiscal slippage that is the main concern. Obviously, a French exit from the EMU is not going to happen. But they've already told us they're not going to be reckless. So I'm not so sure it's going to be that bad. That's why the market would like to see more of a hung parliament so that they can't go out and spend recklessly on this situation. But I think, look, Le Pen's got a presidential election to win in 2027, and she's not going to be able to do that if she loses the bond market. If the bond market says you guys are out of control, you don't know how to do, you don't know what you're doing, similar to Liz Truss in the UK government a couple of years ago, she's not going to win that election. She's not going to win the presidential election. They could be in a position where they have the lower house and the presidency if they get it right, but they're not going to do it by being reckless. They're not going to be austere because they, you obviously get slower growth. So I think the market would be it wouldn't be a great reaction to a majority. But it really depends what happens when they come in. If they start coming in saying we're going to spend and grow the French economy and blow out the deficit, yeah, you're going to see a sell-off, a big sell-off in the bond market. But if they say, look, we're okay there, it's fine. I want to go back to the US side of things because Blake, the bond market now is selling off quite sharply on the long end, and we'll tie this into NFPs because we're sort of going on this quite a lot. But for me, the market is saying Trump's going to come into the White House. We're not trading spot markets, we're not trading FX, we're not trading equities because it's still too far out. But because the bond market's obviously a lot more further looking out, you're seeing a decent sell-off on the long end. You're seeing really strong bear steepening of the curve, and they're saying Trump's probably going to come in. You're going to get an extension of the tax cuts in 2025. You've got tariffs measures there as well. You're going to see a bit of a blowout in the deficit, and that's causing pretty big moves in the bond market there. It's not impacting the dollar at the moment, no, Blake.
No, it's not. But the dollar, I think, it was getting a little cross current from what happened over the weekend. So you have to be a little careful with the dollar, especially this week. Now, tying that into the non-farm payroll, we saw the ISM manufacturing data come in today. It was not good. Prices paid came down quite a bit, which is good. But we've got a lot of other data that we're actually even getting ISM services on Wednesday. So there's a lot of data coming out. And I'm sniffing that we're going to start to see some weak data. So I guess the question to you is, if we get weak data, how you want to play it? Because I have a feeling that let's talk the non-farm payroll. If we see, let's say, jobs, all else being equal, headline number comes in below 100,000. I think the dollar weakens initially, but will it sustain? Because I believe stocks are going to come down too if data comes in that week. How are you seeing NFP this week?
Well, it's a good question. And look, the US dollar is being elevated because of the French political risk premium. Euro dollar, in theory, if you look at a classic rates differential, should be trading at the high 108s. But because of the French risk premium at the moment, it's being held down quite some way. And the US data has been coming in consistently weak. The Citigroup Economic Surprise Index is at the lowest levels in a couple of years. So, the data has been poor. So I think I actually take the other view. I get the logic that weak data will impact stocks, and then you're going to get a dollar rally because of the risk off thematic in equities. But I think that really depends on which currency pair you're playing it against. I mean, the easiest, I think if the unemployment rate above 4.1%, I think would be the big one for me, especially if it was married with a lower average hourly earnings. So I think the market will see what it wants to see. But I get that point. So the data in the US has been coming in weaker. It doesn't matter, dollar yen just keeps going up and up and up. Dollar Swiss looks all right. So you've got to choose your pairs. But I think it'd be an interesting one. And I just want to go into the tech trade there, Blake, because we've just seen US stocks. The breadth is rubbish. It's rubbish. 23% of stocks in the S&P were higher on the day. S&P closed higher. It's just tech and Amazon and Tesla. Tesla looks bloody good actually. But it's just all tech. When does that change? What changes it?
I don't know. And rotation actually works. I mean, when the tech stocks actually slow down, you'll see pickups in other industries. So I don't know. The tech trade still looks good. And you're right, breath stinks, but it can continue on for a while. But one thing that might actually impact the market is this creep up that we are seeing in crude. When crude broke the 618 retracement last week around $82, it started trading up pretty aggressively. And I believe that crude is at that impasse where higher prices are not good. The market's not going to view it as a positive. Even though today, stocks held up pretty well, crude rallied. But what happens if crude takes out 85 or 90? Is that going to be, or is the market going to start seeing that as like more of a constriction on the consumer? What do you think about this move in crude, Chris?
Yeah, it's an interesting one. I mean, because break-even rates or markets average inflation expectations have started moving up as they do. They follow the crude price very, very closely as well. But I think it's a bit of a toxic mix. If we were to see a lot of the growth data points really starting to show some red flags, and the recession is still a low probability anytime soon. But if that was to increase and be brought forward, and then you have a higher crude price, that's not a great mix. But I don't think we're at levels which are too concerning at the moment. I think if you get into the high 90s, into $100, psychologically it will start impacting. But I don't think we're there yet at the moment. I think there's other factors that have to play. But I like being long crude. I think pullbacks will be shallow, and I think it goes higher. And we'll look at a chart at the moment. So an interesting time. We're looking at politics and the impact that's having on markets. I still think the US situation is the big one there. Data is slowing down in the US, but payrolls is going to be a big one. Specifically, I'm looking at the unemployment rate. The tech trade continues to dominate, and crude. I mean, they're big factors playing through in markets. Anyway, let's go to the technical factors in That's a Setup and have a look there. I'm going to start with Euro Sterling, the political pair. Why? Well, we've got a UK election coming up this week. Labour obviously expected to win that one quite convincingly. I'm not sure there's going to be huge volatility that comes through the pound, but most people are saying that is probably going to be net positive for the pound in some capacity there. But then look, you've got the Euro Sterling, which has come up and closed the gap that once we got the Monday the opening gap, once obviously Macron called the legislative elections. And then that sort of pulled back into 84 pence. And then we've just had a nice move up. So we are at the point where we've closed the gap. And it's what happens when you close the gap that's most important here. So do we get a rejection? A rejection lower would be very, very powerful and very telling indeed. Or do we break through and then you get a continuation move that we play through that when you're obviously trading gaps? I like this lower. I wouldn't see a bit of selling coming through, so I'd take the time frame down into a 30-minute, 1 hour chart and watch that a bit more closely. I think we've had a bit of a short covering move in Europe, but I still think there's a lot to play for. I don't think we're out of the woods in Europe yet, so I like this one lower, but we're at a very make or break time. We've closed the gap. It's what happens here that's very, very telling now.
Chris, I'm glad you brought that up, and it's music to my ears. Don't tell anybody I told you this, but I shorted some Euro Sterling today as well.
I'm not going to tell anyone, mate.
Don't tell a soul. All right, so let me bring you my first setup, which will be the Kiwi yen. Now, you say Kiwi the yen has no friends or very few friends, but maybe Fibonacci is there. The golden ratio of the last intervention comes in at the 161% extension, which is 98.36. We stopped there on a dime and we reversed a little bit off that level. Now, I don't know if this is a great short just yet. And I'm not even sure if we're even going to get down to that blue line, which I say is the level to watch. But that level comes in at 97.29 or 97.30. And I mean, it's basically 100 pips away from where we're at, or a little less than that. But that's the level I'm going to be looking at. We start breaking below that. That means we're taking out previous resistance levels. That would be current support, and a move below that 96.30 level might suggest that we might have a little bit of a pullback. Now, I have to say, daily sentiment index comes in at 12, which is pretty extreme for the yen. So that's another thing that's kind of hanging over this one's head. So I think it's a good setup. I think you got the levels to watch, and it's one that's going to be on my radar right now.
Bit of a cheeky divergence playing through in the RSI and price action there as well. But I think the yen's a little bit like the England football team, isn't it? Just absolutely ugly to watch. But still people believe in it, and I'm not sure why, but that's kind of where we are. Anyway, let's switch on to crude. Let's switch on to crude because we talked about it just then. But I love the shape that we're seeing here. It's kind of like an inverse head and shoulders in a way, but we came back, we broke out of the recent range highs. We we pushed higher, we failed, we consolidated, but look, you can see those continuous bids that just came out around $80, just into that former breakout level. The market just found support time and time again. And then we got the really powerful breakout with range expansion. Now, obviously, that doesn't suggest that we're guaranteed to move higher, but it does. Again, it comes back to our idea about distributions. Where is the probability of a move? Is there a greater probability of it moving higher, sideways, or down? And that's the only way that we can think in trading. And I suspect, given the way that it's been trading technically, despite inventory levels breaking out to the highest level in some time, the market is telling you that the bulls are in control. That does skew the probability of a higher levels. $86 would be where I'd suspect it will continue to go to. And if you have a look at the futures curve at the moment, it's so backwardated that people are just incentivized to buy, because you hold those long positions, you get to expiration and you roll it down to cheaper levels. It just makes a lot of sense. So I just love what I'm seeing in the crude market. It's obviously very tight supply playing through. I'll be buying pullbacks into the 5-day exponential moving average, which I don't have here. But I feel like the probabilities are skewed for higher levels here.
Well, I think the price action looks extremely bullish, Chris. And while it's above $80, there's no reason to look the other direction, in my opinion. So, all right. My last setup is going to be the SPOOs. It's going to be the S&P. And I actually brought you a 4-hour chart for all you day traders out there. I'm looking at last week's price action, a little bit of a double top near the 161% extension of the last major move down, which wasn't that long ago. We call that a major move. I don't know if that was really a major move back in April. Anyway, we hit the 161% extension. Today, we found the low at the 24% retracement that comes in about 54.50, well, 54.45 according to the Pepperstone CFD. So watch that 24% retracement level, because if that breaks, the extension actually takes us back down towards 53.50. So I think there's a little bit of downside if we break down. Right now, it's obviously a very bullish trend, but I'm getting itchy, Chris, for a short. And I think if you're getting itchy, you got to look at that 24% fib level. And I think that's the level that if it breaks, this is a setup. You might get a nice little counter trend move. It's not going to wreck the market, but could we get a little bit of a pullback? I think it's a good setup for people that are looking to play counter trend.
Yeah, and watch the bond market as well, because if we do see high real yields and high nominal treasury yields, yeah, maybe the tech trade does give up, because you start looking at the cash flows, you discount the cash flows using the 10-year as your discount, and suddenly they become slightly less attractive. Maybe that's the thing that gives up the tech trade. So yeah, we are looking at the long end of the curve, big steepening playing through. There's a big trade there in fixed income at the moment. People are long the front end, long twos, they're short tens, and that's the big sort of institutional trade now. But maybe that higher long end will impact the expected cash flows or the net present value of these businesses and drives it lower. Everything else is looking pretty crap at the moment, to be honest, but you've got tech's holding it in there by a thread. So obviously an interesting one. Anyway, let's go to play of the day. We're talking about hanging in by a thread. Again, I just come back to my old chestnut, the pairs trades, short long trades, and long short strategies. Back again to this. Yes, being short small caps, being long the tech trade. Now, obviously, the risk that I've just portrayed there is that we do see a further move higher in both 10-year real rates, which is the nominal treasury adjusted for expected inflation over that period, or TIPS, or there's just the 10-year just generic treasury, which is trading around 4.4% at the moment, or just above that level. That's probably the risk for the tech trade as we go into the earnings season. Now, Nvidia, obviously the linchpin of that, they don't report until the 23rd of August, and I wouldn't suspect that we may see a sell the fact playing through in Nvidia later on, once we realise that we've got peak margins and the net margins are going to go down to about 75%. So there are risks, obviously, with tech, but at the moment, the way it's trading, Microsoft looks bloody good. Apple looks like it wants to break 220. Nvidia is holding in, finding really good support around 120. It all still looks really well supported, and there's still some momentum. So I feel this is it. But US small caps still trade poorly. So there's an art to trading long short strategies, pairs trading. Obviously, you might want to beta weight it, or you might want to look at volatility adjusting. But right now, I just think for me, being short the US 2000 or the Russell 2000, being long the NASDAQ, just continues to work, and you can see that ratio looking like it wants to head lower, in my opinion, there. So I think that's a trade for me. Continue there.
Well, it's a continuation, and in a very from left to right, it's moving down. Really, really bearish chart. So I like it. Chris, my play of the day is going to be the dollar MEX. I believe we are in the midst of a Wyckoff accumulation pattern. Now we're like midway through the accumulation point, and we've actually pulled back to a 38% retracement at 1795. We dropped to 1790 last week. We held it basically, and now we're consolidating gains. If you're short, you're probably thinking, oh boy, if this thing doesn't relinquish 18 soon, next thing you know, we're going to be trading back up at 19 again. Now, an ABCD equal leg move would take us well above 20 towards 2040. I believe that we are just consolidating recent gains. So a move above 1860, 18.0.60, puts new highs in play above 19. I've been playing it on the long side, Chris. I keep buying dips, and I still think that without when the new government comes into Mexico, we're going to see a continued rally in the dollar MEX. So this one is Taco Tuesday. I get to say Taco Tuesday because it's Tuesday in Australia. So you guys get Taco Tuesday today.
Yeah, I'm going to be living and breathing that all day. So, but just remember as well, in 2016, 2020, the dollar MEX was by far and away the vol pair to trade the election. So whilst I wouldn't be trading spot now, it's way too early. Spot moves are going to take place in FX markets as they were doing spot equity markets, probably after the second presidential debate, which takes place on the 10th of September. I think that's when we'll start placing those trades there. But the bond market's starting to react. And maybe the FX market will suddenly go, yeah, we're going to watch the bond market. And dollar MEX has been the most volatile pair by some way, so it could be a good political one to start thinking about and putting on the radar longer term. Anyway, thank you, Mr. Blake Morrow. Enjoy your 4th of July celebrations, and for all our other US based viewers, hope you have a great time, and for everyone else, we'll see you next week.